Welcome to the deep dive. Today, we're looking at some sources you sent in, focusing on something, well, a question that pops up a lot for people looking at trading.
Yeah, definitely.
There's this one piece. It's a chat between a trader, Manish, and his daughter, Mansi, and it really nails the question. If simple strategies, like mean reversion or chatting consolidation breakouts, breakout retests, if they're based on solid ideas and can make money, why do, over 90% of traders lose?
That number is just, wow. It really makes you pause, doesn't it?
It does.
Because you see the logic, right? Buying something that's fallen hard, hoping it bounces back. Or jumping on momentum when a price breaks free.
Yeah.
The ideas make sense. But yeah, like you said, the reality for most people trying it is, well, not great.
Yeah.
So our goal here, using what's in these sources, especially that conversation, is to figure out why. What are the real world hurdles, the psychological stuff, the practical execution things that trip people up, even with a seemingly simple plan.
Right, and I think the confusion you might be feeling, it's exactly what Mansi asks in that conversation. You see these clear ideas, but that huge failure rate, it's worrying.
Totally.
But the good news, and this source confirms this, is that the basic idea is sound. Simple strategies can work. They often tap into how markets, tend to behave over time.
Absolutely. The sources back that up. The problem usually isn't the strategy's core concept itself.
Okay.
The main argument we're seeing, and Manish lays it out really well, is that success isn't just about finding a pattern on a chart. It's more about managing yourself, your discipline, how you actually execute, and controlling your risk.
Okay, so let's break that down. What does the conversation say is the number one biggest obstacle? It's not finding some complex indicator, is it?
No, not at all. It's psychology. Plain and simple, your own emotions.
Oh, okay. That makes sense.
Yeah, the source puts a huge weight on this. Manish basically says emotions are the single biggest barrier. Think about mean reversion for a second. Buying when things look weak, right?
Right, buy the dip.
Exactly. The strategy says, buy now, it's oversold. But actually doing that, when you see prices falling, maybe your account dipping.
Yeah.
Fear kicks in. Hard.
Yeah. Mm-hmm.
And the source points out how that fear makes traders, hesitate. Or they second guess a perfectly good signal from their strategy. Sometimes they just freeze up. Can't pull the trigger.
And if they do manage to get in and the trade maybe goes against them just a little bit initially.
Then the fear can make them panic sell.
Ah, okay.
Yeah, even if the trade is still technically okay according to the strategy's rules, that feeling of losing money is just too uncomfortable. So they jump out too early, take a small loss they maybe didn't need to,
Yeah.
often right before it might have turned around.
Okay, so fear stops you or makes you bail too soon. What about the other big emotion? Greed.
Yep, that's the flip side. Just as damaging.
How so?
Well, let's say you have a winning trade. Your strategy has a clear target for taking profit. Makes sense. Lock it in. But greed starts talking. Oh, this could go way higher. Just hold on a bit longer. So traders ignore their plan, hoping for that extra bit of profit.
And then?
And then, often, the market reverses. They watch all those paper profits disappear. Sometimes a winning trade even turns into a losing one, just because they got greedy and didn't stick to the plan.
Wow.
So the key takeaway, and it's hammered home in this conversation, is that how you react emotionally, fear or greed, is often what stops you from actually doing what your strategy says you should do. Consistently, anyway.
Right, so it's not enough to know the rules. You have to actually follow them when you're feeling stressed or excited. What's the next big pitfall the sources highlight?
This one's huge, too. A serious lack of proper risk management. It's described as, well, potentially devastating.
Okay.
The conversation uses a consolidation breakout as an example. Price is stuck in a range, then it breaks higher. You buy. Okay, seems logical. But what if it's a fake out? Price pops up, then slams right back down into the range. Happens all the time. Now, if you bet too much on that one trade, and the source mentions people risking like 10%, even 20% of their entire account.
20% on one trade, that's risky.
It's basically gambling at that point, isn't it? That one bad trade, which is bound to happen sometimes, can just wipe out a massive chunk of your capital, might even knock you out of trading completely.
So what's the alternative? How should people manage that risk?
Well, the sources are clear.
Yeah.
Many traders just don't have the basics in place, like a stop-loss order, an automatic exit if the price drops to a certain point,
Yeah.
proper position sizing.
Position sizing.
Yeah, figuring out how much to buy or sell based on your account size and where your stop-loss is, so that if you do lose, the loss is only a small, manageable percentage of your total capital.
Not 10 or 20%.
Exactly. They're swinging for the fences every time, hoping for that one massive win. But Manish in the conversation explains you will have losing trades. It's part of the game. If your risk per trade is too high, those inevitable losses just eat up your account way too fast.
So what's the recommendation then?
The advice given is pretty standard but crucial. Risk no more than, say, 1% or maybe 2% of your total trading capital on any single trade.
1 or 2%, okay.
Yeah. That way, even if you hit a bad patch, maybe 10 or even 20 losses in a row, which can happen.
Wow, yeah.
It won't destroy your account. You can survive, you can learn, you can keep trading. It keeps you in the game.
Okay, so controlling emotions, controlling risk, critical.
Yeah.
What about the strategy itself? You hear so much about finding the perfect system. What did the sources say?
The conversation touches on this, and it's actually kind of amusing how Manish talks about, online gurus and their secret can't-lose strategies.
Yeah, you see those everywhere.
The reality check in the source is pretty blunt.
Hmm.
No strategy works 100% of the time. Why? Because markets change. They aren't static.
So context matters.
Hugely.
Yeah.
Take that breakout retest strategy. Works great when the market is clearly trending, moving strongly in one direction. Momentum helps. But try using that same strategy in a market that's just chopping sideways, going nowhere. It'll likely fail over and over. You'll get faked out constantly.
So it's not just having a strategy, but knowing when it's likely to work, understanding the market weather, so to speak.
That's a great way to put it. The sources stress that a lot of traders fail because they skip that step. They don't really look at the bigger picture. Is the market trending? Is it stuck in a range? Is it super volatile? Is there big news coming out that could shake things up?
They just want to trade their pattern.
Right. They try to force their setup onto whatever the market is doing, regardless of whether the conditions are right for it. And a really key piece of advice from that conversation is about patience. Sometimes the smartest thing you can do is nothing. Just wait for the right conditions for your strategy. Like Manish says, sometimes the best trade is no trade at all.
Waiting. Yeah, that feels counterintuitive when you're trying to make money, right? You feel like you should always be doing something.
Absolutely. And that feeling, that impatience, leads straight into another major problem the sources identify: overtrading.
Ah, okay. Trading too much?
Yeah. Someone finds a simple strategy, maybe it works a few times, and they think, great, this is a money machine. So they start trying to trade it constantly, every little wiggle on the chart.
But every trade has costs, right?
Exactly.
Yep.
There are spreads, maybe commissions, but also, importantly, emotional energy, mental bandwidth.
Mm-hmm.
The sources argue that just being in the market all the time, taking trades that aren't really A-plus setups according to your own rules, it just grinds you down and stacks the odds against you because of those costs and the increased chance of making emotional mistakes.
So better to be selective.
That's the message. Good traders, even using simple methods, learn to wait patiently for that high probability setup, the one that really fits their plan, even if it means sitting on their hands for days.
Okay, so we've got emotions, risk, market context, not overtrading. Is there anything else contributing to that scary 90% loss rate?
Yes, one more big one that ties a lot of this together: unrealistic expectations.
Ah, thinking you'll get rich quick.
Pretty much. So many people jump into trading thinking they'll double their account in a few weeks or months. It's just not how it usually works for sustainable trading.
Right.
They might see a strategy, like the mean reversion example mentioned, maybe it wins 60% of the time historically, and they think, okay, 60%, I'm golden.
But 60% wins means 40% losses. That's still a lot of losing trades.
Precisely. And markets move in cycles. Even a great strategy will have losing streaks. It's unavoidable. So if a trader goes in without a realistic goal, maybe aiming for a steady, modest return per month, while keeping that risk super tight, they get discouraged really fast when they hit that first inevitable rough patch or drawdown.
And then what happens?
They get frustrated, they doubt the strategy, maybe they ditch it altogether and start chasing the next holy grail, or worse, they start revenge trading, trying to win back losses quickly, usually by breaking all the risk rules and just dig a deeper hole.
Okay, so putting it all together, the main message from these sources, especially that father-daughter talk, sounds like trading isn't a slot machine. It's a serious business.
That's exactly the conclusion. It's framed as a marathon, requires a business-like approach, not a sprint to get rich.
Right.
And the reason that 90% or so fail is often because they treat it like a sprint or a casino. They don't have the discipline, they risk way too much, they trade on impulse instead of waiting for good setups, they overtrade out of boredom or impatience, and they're chasing impossible returns without a solid plan.
Which loops us back perfectly to the start. A simple strategy can work. The logic can be sound.
Yes, but only if the person using it can master themselves first and treat the whole thing with discipline, like running a business. The strategy itself is almost secondary to the trader's mindset and execution.
So based on the advice Manish gives Mansi in that conversation, advice that applies to anyone listening who wants to avoid being in that 90%, what are the practical steps? What should you actually do?
Yet, the advice is very down to earth. First,
Mm.
start small, really small. Use money you can genuinely afford to lose while you're learning the ropes.
Okay, sensible.
Second, seriously consider using a demo account at first. Paper trading. Test your strategy. Prove to yourself you can actually follow the rules consistently without the pressure of real money on the line.
Get the process down first.
Exactly. Then, crucially, write down your trading plan. What are your exact rules for getting into a trade? Getting out, how much you're risking per trade, write it all down. And then the source really emphasizes this. Stick to that plan like it's law. No exceptions based on feelings.
That sounds hard.
It is. That's the discipline part. Also, keep a journal. Track every single trade wins and losses. Why did you take it? What happened? This helps you learn from your actual actions and mistakes, not just theory.
So you can see your own patterns.
Right. And be patient. Super patient. Focus less on the money, especially at the start, and more on the process. Focus on learning, executing your plan consistently, building that self-discipline.
Okay, so let's quickly recap the big reasons people fail with simple strategies, according to these sources. It's the emotions, fear, and greed.